Does your startup need to get a SOC 2 report to close big deals? Or do you already have a SOC 2 report and want to make it easier to maintain year after year? Vanta has built software that makes it easier to both get and renew your SOC 2. With Vanta, you avoid anxious auditor interviews, and you don't have to capture hundreds of screenshots proving that you are SOC 2 compliant to your auditor. Companies like Lattice, User Testing, and hundreds of others have successfully gotten their SOC 2 reports with Vanta. Equity listeners can redeem $1,000 off a Vanta subscription by visiting vanta.com/equity. That's vanta.com/equity.
And welcome back to Equity, TechCrunch's venture capital focused podcast where we unpack the numbers behind the headlines. My name is Alex Wilhelm, and I'm here with two of my favorite people in the whole world. We'll start on my right. Natasha Mascarenhas, how are you doing?
Last week I was a 3 out of 10. This week I am a 3.3 out of 10.
It's been a trying period for everybody, I feel. Danny Crichton, how are you doing? What's your out of 10?
I'm doing great. I mean, How can it not be better?
We want a number out of 10, though. You need to distill that down to a decimal for us.
I'm up 1 point, which is a lot better than Tesla stock these days.
Yeah, Tesla had a rough end of the week, it looked like. Well, I'll follow suit. I'm a 4.7 out of 10. So beating Natasha, trailing Danny, but doing better than Musk. And with that, I think we can kick off. We're going to start with a funny round this week. We're going to flip it around, not start with public markets, put that at the back of the show, kick the early stage stuff to the front. Just because there's been so many IPOs and SPACs lately, we all know we're a little bit tired of it. So we're going to start with the more fun stuff and then get to the homework at the end.
When Alex says he's tired of it, what he really means is he's been yelled at on Twitter.
Yeah, I'm not tired of it at all. That was
I am very tired of it. So any equity listeners on my side, welcome. We're starting with private this week, and we're going to kick it off with Climax Foods, which raised a $7.5 million round and it was founded by an Impossible Foods and Google data scientist. And it's one of those new startups that are also trying to create a meat alternative. It's scanning for different proteins and then that exist in animal food products and trying to replicate them in a way that doesn't use animal protein. It's starting with cheese.
Which, to be clear, I know a lot about because I'm a cheese eater and I have many opinions about cheese. So I think they're taking on something pretty hard because if you say like, here's a faux Gouda, I'm going to be like, I've eaten pounds of Gouda. I know exactly how I like my Gouda. I buy expensive Gouda because I like it. And I'm going to go for it. I think my opinion after reading through this round is that this is the future. And I'm just going to be a little bit slow to accepting that. Like, I think the meat explosion has happened. Cheese will be next. And we already do nut-based dairy. So, I think that's already happened. So, I'm excited. Yeah, Danny, what do you think? How's your diet going to change?
I like cheese. I grew up in Minnesota, which is, next to the cheese capital of the country. Look, I mean, meat replacement has done really well, right? We've seen, what was it, Beyond Meat? I forget the official term.
There's Beyond Meat
Foods,
and Impossible Foods, exactly.
And unbelievable, I can't believe it's not butter cheese. So I'm looking forward to a whole selection of I guess, meat, protein, animal protein replaced products. It's great. Let's expand the grocery store a little bit beyond cows.
This was One Ventures, Manta Ray Ventures, S2G Ventures, Valor Siren Ventures, Prelude Ventures, Artis Ventures, Index Ventures, Luminous Ventures, Canaccord Genuity Group, I believe, Carrot Capital, and Global
so
Founders
Carrot Capital. I don't know who they are, but they're the only ones that seem relevant in this context.
I mean, they are on brand for the plant-based food. Look, they should just call themselves I Can't Believe It's Not Cheese, and then we could have avoided not making jokes about their name for this entire last 2 minutes. And I think that would be a more appropriate title because we struggled during prep for this particular bit of the show. Anyways,
I was going to say, we don't talk about kind of like the future of food often on this show, but I think it's something we should be looking into more because I think we saw Impossible Foods do a meat alternative that people are kind of taking seriously, but there's no way that it's going to start and stop with Impossible Foods and Beyond Meat. So it'll be cool to see the next wave approach things that haven't been done before.
Yeah, on that point, I really think that's interesting to see how people talk about not eating meat, not just because of animal cruelty points,
right,
but also because of climate change points. And the founder, I think it was Oliver Zahn, in this piece that Sheba wrote for us, talked about the I can find the word, environmental impact of the meat industry and how it's simply enormous from a carbon footprint perspective. So I think that I would have scoffed at 5 years ago, like, oh, who really cares? But now I think it's actually a relatively large chunk of the population.
Well, my guess is it's actually also a great market, right? Unlike meat, where meat is meat, right? You're eating beef. Beef has a certain flavor, certain texture you expect in a hamburger. Cheese has a huge spectrum of diversity, right? You have hard cheeses, sharp cheeses, soft cheeses, everything in between. But I think there's a little bit more flexibility in terms of producing a product that seems like something that it should exist in the cheese spectrum compared to meat.
So not Gouda per se, it's going to be kind of Nuda, and then it'll be a new
Nuda.
cheese. The moment I said it, it didn't come out well. Yeah.
You can go copyright that right away.
I'm not going to. I'm going to pretend like I didn't say it and move us on to Capchase. Capchase raised a $4.6 million round to, quote, deliver fast cash to SaaS companies. Danny, I read this, but I want you to talk us through why we need one more way to tinker with SaaS incomes.
Yeah, so if we're starting with Climax Foods, I think Capchase is really kind of the opposite of that. Like, so this is a cash cycle conversion optimization startup.
Yeah.
And you would be totally excused for giving up on this podcast, unsubscribing, and moving on to, I don't know, like catvideo.com or something like that. Hopefully that's not a porn site.
You're such a boomer. I love it. Catvideos.com. Dude, TikTok.
TikTok. Well, TikTok's only got 17 days, 16 days left to go on the ticker. So hopefully a buzzer beater is coming shortly. But look, Capchase is taking advantage of a new market, which is there are now hundreds, if not thousands, of SaaS companies making revenues. And one of the most common challenges with most SaaS companies is you have customers that sign multi-month, multi-year purchase agreements. So they'll say, hey, we're going to spend $2,000 a month for the next 2 years. That's $48,000 across the total contract, what's known as the total contract value, or TCV. The challenge is you can't get that money up front. And startups want money up front to pay for payroll, cash flow, growth, etc. Today, most startups go and get venture debt. They get what's known as a accounts receivable line. Capchase is trying to make it a much more frictionless and pain-free way to get an AR line.
And the cool thing is here, so if you sell a contract for $100,000, and instead of getting that over 24 small chunks, you can sell it to Capchase, effectively get $95K of that up front. They take the $5K. It's not super cheap compared to certain interest rates, but certainly if you're a startup that wants to avoid taking on long-term debts or wants to avoid taking on capital to preserve dilution, I think it's cool. And Danny, I don't even really care how well Capchase does. I just like to see the explosion of different options for SaaS fundraising, given how it's kind of the de facto startup business model these days. Super cool to see innovation there, and I presume the competition will lead to an aggregate lower cost of capital, which is a net good for all startups that participate in kind of the new digital economy.
Yeah, well, certainly. And look, a lot of SaaS companies don't have any options, right? When you're super early and you're a credit risk, banks won't lend. So what most startups do early on is they actually give huge discounts to customers to do payments up front. Something on the order of 30 to 50% of the value as a discount. So that's really where Capchase is competing against, is those early customers where if there's a signed contract, look, the credit risk is really on the customer's part. Is the customer going to pay? So, they're really evaluating, if Xerox signs a 2-year contract, is Xerox going to pay for 2 years through the end of that? And if they are, it's a pretty good credit risk.
And I just want to add too, I feel like branding is so important here. They called themselves the non-dilutive revolution, which I'm not going to make fun of, because truly non-dilution is music to founders' ears, smart founders' ears during the pandemic and kind of going forward. You saw Clearbank kind of use a similar pitch, right? The anti-VC angle is really interesting for startups. Clearbank's different, but it's just another example of startups joining this and kind of hinging themselves off of the anti-VC route.
In many ways, you could say that they are the solution to non-dilution. And that is a chemistry joke and not one we get often on this podcast. But that's enough about Capchase and cash cycle conversion optimization, because again, if you haven't unsubscribed after hearing that phrase, something is very wrong with you. But Natasha, you're going to talk about Envision, which is not the Envision we normally talk about, but Envision. Envision.
Danny, you had a great transition, but let me just make it clear. People thought we were going to do cheese puns. I thought we were going to do cheese puns, but instead we're doing SaaS securitization puns. And that makes me love you guys even more. Alex,
that's what you pay for equity.
Everyone pays what it's worth.
I love that I was like anti-equity on equity, but I feel like that just defines
that's
me.
Okay.
That's fine.
It's okay. We have haters on the show. I mean, just read our Twitter feed.
Read
I read our reviews on Apple Podcasts the other day.
No,
and
don't
that
do
was
it.
a mistake.
That was, I should have told you, don't do it. They're all, It's only people who are mad.
I was in a bad mood and I was like, let me just give myself more things to be mad about. Anyways, good news is that Alex wrote a great piece about student-led accelerator Envision. Talk to us about what you found out, Alex.
Okay, so a couple months ago, some people reached out to me via email, just completely cold, didn't know them, no shared context that I knew of at the time. And they're like, hey, we're a couple of recent grads, we're working with a bunch of students. We are building a virtual accelerator aimed at bringing lots of diverse founders into the mix. We're going to give them $10K in non-dilutive capital. We put together an awesome program. We've got killer advisors, and we're going to run them through this 8-week thing and then have a virtual demo day. And I was like, how old are you? And they're like, we just graduated. And I was like, oh, when I was your age, I was partying. And so I was very impressed with them. And I was curious to see how it would go as an experiment. So I covered the early stage, and I was waiting to hear from them kind of at the end. And of course, they reached out and they were finishing up and we caught up. And they got 17 companies through their accelerator, and they're already planning their next one for October, so they can do a 10-week program before the end of the year. So students who are taking the first semester off due to COVID, whatever, can do this. And they had some just simply insane stats. Of the 17 companies that they worked with, 1/3 of the founders were Black, around 1 in 5 were Latinx, and more than 75% of the companies had at least one female founder, which just goes to show that there are diverse founders out there if you go and bring them in. And I do think the virtual element allows for a much more diverse crop to appear, even though we didn't see that, Natasha, in the Y Combinator data, which we can talk about if we want to. But I'm just super stoked. The people that I know best there are Annabelle Strauss and Eliana Berger, super smart people. And I was talking to a local Providence entrepreneur yesterday. We were doing a socially distanced coffee, my first for work since March. And it turns out he knows both of them. So it turns out we actually did have a shared network. I didn't know that at the time. But yeah, I'm just impressed. I love seeing people that I still put in the young bucket, even though I don't mean that in a dismissive way at all, do very impressive things and shake things up and show that all the problems that these more established players are having with diversity are maybe more self-inflicted than market-based, is my read.
This is definitely where I'm finding hope right now. And, there's the conversation we've had on this podcast before about how now anyone can become an accelerator. Is that good or bad? This is an example of why it's good in some ways. And on the point of diversity, I feel like explicitness matters so much, intention matters so much. And if a couple of students who don't have the same network as insert big name VC firm here can invest in diverse founders, then anyone can. And a VC I was talking to the other day was like, we need to stop doing the narrative of that it's hard for underrepresented people to get capital because it is the best time for underrepresented people to get capital. It's not easy, but it's also like gonna shoot people in the foot earlier than they even try if we keep pushing this idea that there's no one out there looking for underrepresented founders to invest in.
Yeah, one more quick note about the Envision group, just because I can shout this out because we're on air. If you go to envisionaccelerator.com, ENVISION accelerator.com/portfolio, you can see all the companies and kind of what they do. So if you want to see some really, really early stage student-y led companies, to see what the kids are thinking about, take a peek. Again, not being dismissive, being super stoked about this really cool stuff. And I think, Natasha, you are correct. And with that, we are going to turn to a topic that I can't ignore anymore. I've always ignored EdTech. I thought it was dull. I've never liked it. And Natasha,
education.
Kids
are learning things.
I mean, I did want to drop out of every school I've been in. I never actually pulled it off. But it turns out that this COVID boom is not a COVID bump. It's a COVID explosion in the EdTech world, a wave of stuff. And so we have a number of things that I'm going to now shut up and let Natasha walk us through. So Natasha, EdTech, please.
Yes, I'm going to go fast with the news bits and then talk about what the most interesting part is. So Owl Venture, which is an EdTech focused fund, one of the biggest, as it claims, got a $585 million pair of funds that it closed fully over Zoom during the pandemic. It's also invested in the most valuable EdTech company in the world, Byju's. So you can connect the dots there on why it's doing well. Course Hero, which is a profitable unicorn, became a unicorn a couple months ago, raised 10 million then raised an extension round, quote unquote, of 70 million. And then Junie Learning is a live tutoring startup that was coming up against some huge players. They closed a 10.5 million Series A by Forerunner Ventures, a consumer-focused fund, and have 10 million in ARR, compared to 2 million of ARR in March. Now, the thing I want to talk to you guys about too is like, we talk a lot about the EdTech boom, but up until this point, it was very much like a boom from consumers, a boom from parents, kids, et cetera, et cetera. Now with schools reopening, we're seeing the boom and what some people are calling a second surge start from schools starting to invest in edtech platforms. That does not happen. People do not pitch to schools. It's the easiest way to die as an edtech startup. And so it's been cool to see the boom kind of transition from being solely consumer to actual B2B.
So yesterday I caught up with the CFO of Jamf, which is the Apple MDM company. And I was talking to her about the edtech market in particular. I'm like, what are you seeing? Is it explosive? And I think if I recall, I can't find my notes while we're recording. It'll take too long. But the gist was that it's going to be a kind of a sustained thing because not all schools are starting at the same time. And given the delayed and kind of staggered rollout, demand that she sees, which is mostly software for Apple devices that are given to students so they can participate in remote learning, is going to be staggered. So I think when we discuss the boom, Natasha, it could have some long-term legs. And so I think this wave will persist for multiple quarters, which is enormous for the sector and probably part of why we're seeing such fast investments now to get ahead of those later higher valuations.
Definitely. I mean, I think a part of me, when I put my reporter hat on, which should be always, is I'm like, okay, what's the post-pandemic trend though? And I think a lot of people are, saying that it's not just these, like I'm sure there's hype in edtech. There's definitely hype in edtech, but for example, like VR labs for science class, I was talking to Owl Ventures and they were like, it doesn't have to be scientific to get investment interest from us now. Like that is still interesting to us, but we're also still interested in the, Q&A services like Quizlet. If Quizlet was pitched to us now, we'd still be interested in it. And hearing that kind of balance and that it's not just only, VR being applied to education as the next wave of edtech startups also gave me more faith in like what a post-pandemic edtech space looks like.
Looking at this set of news that you brought up, the thing that really exploded in my head more than anything was the size of the Course Hero extension from a $10 million Series B to an $80 million Series B, which is, I don't think anything I've ever seen before. Extensions tend to be, equally sized to the preceding tranche at most, right? So this was an insane thing. That implies to me that investors are, excited about this company and what it's doing. So it implies such a demand surge that I don't think even when it does abate post-COVID, as you were discussing, it's going to go down to zero. I think we're at a new higher plateau or higher plane of growth for these companies. Because a bit like how I don't think conferences are ever going to go back to exactly what they were. I think there'll always now be a hybrid digital element to global tech conferences or pharmaceutical, whatever it is, given that we now have the tech experience and know-how to do that. I think education is going to be very similar. There's going to be more of a remote component to it that lets it be more accessible to more people. And that means higher demand for this stuff net long-term, even if the growth rate descends to a more historically normal level, I think.
Right. With Course Hero, for example, it's, total addressable market. They thought it was 1 million students. Now the CEO says it's millions of, more than millions, right? And so I think they're starting to realize, to your point, Alex, that it's much bigger than even they thought.
Yeah, I mean, when your TAM triples, that unlocks some venture capital opportunities for you. Danny, if you're a VC, right, and the company that you're investing in all of a sudden thinks their TAM goes up by a factor of 3, you would want to give them money ASAP so they can go and spend it on S&M and go after that increased market, right?
Maybe. I mean, to me, I'm very excited here, right? I think that the coronavirus pandemic has scrambled the entire education market, right? Everything from individual tutors, which is what we were talking about with the last company, to the infrastructure that actually empowers classes, to the fact that a lot of folks are moving online from offline. All that is really positive from a technology perspective. I think the question is ultimately, where are these budgets going to come from? We're talking a little bit about this transition to B2B. Well, school districts have no money because taxes are way down. Universities are being, are crippled from state, budgets. Foreign students not paying full fees, tuition's going down. So I think a huge amount of it is still focused on consumers. I think that a lot of these technologies are going to end up substituting for existing kind of infrastructure. And so I see a lot of cannibalization. Rafat Ali, who was talking about events and kind of the collapse of the events business, brought back this quote from 20 years ago about how, analog dollars become digital pennies. And I think we're going to see something very similar in the education space where, the $100,000 tuition and cost of living to go to a business school, let's say for an MBA annually, is going to be replaced by a $1,500 course online that's roughly equivalent. And that to me is going to be the magic in the next couple of years. And there's going to be real winners and losers. So I think the TAM is definitely increasing. I would buy into that. If I was an early stage investor, I would be just counting my laurels. This looks like a huge win. You got some wind in the sails in, the later years of a company. If you're investing now, that's trickier to me, right? Because there's a ton of companies already on the map, dozens that are already years in. You have a bunch of new ones coming on. I'd be more careful at the seed and A.
This is why Danny famously gave up VC to become a long-term value investor on the stock market. That level of caution. I want to, before we move on to other funding rounds, because there's a lot more to get to, I want to point out that I was initially terrified when Danny said, traditional dollars become digital pennies, or whatever that quote was. And then I realized
analog dollars become digital pennies.
I was so close to getting that right, and yet so wrong. I want to point out how I was initially terrified. I'm like, oh, that means revenue will be smaller. But then I realized the opportunity that unlocks. I have not gone to business school because the opportunity cost of not working for 2 years plus the cost of business school made the math look really crappy. Just I'd have to have a 50% income jump, and I want to stay in my profession, so it's not going to happen. So I never went. But if it was take 3 months off, pay $5,000, do it online or whatever it is, and just spend all my time doing that, I would definitely do that. Just take a leave of absence and go and get an MBA if it was cheaper, right? And therefore more cost effective. So I think there's a cool silver lining to this in terms of access.
And the flattening and the access is not just for the US, right? It goes internationally, so people around the world can take the exact same classes that you could in Boston or New York. So or vice versa. So to me, there's this huge globalization that's going to kick in, huge flattening, affordability is coming back. I mean, it's amazing to see in education.
And any stigma that there maybe would have been with online credentials or online degrees is effectively gone now, because everything is an online degree.
Yeah. Also, I read a really great thread today about how parents of kids in elementary school are watching their children learn on Zoom, or as it were, not learn on Zoom. Probably the funniest thread on Twitter I've read in some time. All right. But we're going to put a stop to this. I'm sure Edtech will be back next week because Edtech is the new SaaS, apparently, and we can't get away from it. But we are going to talk about Patreon and its enormous new round. Natasha, can you tell us just the broad strokes here, and then I want to dig into the trends behind it.
Yes, so Patreon is our newest unicorn. It raised $90 million and is valued at $1.2 billion. And it last raised a year ago at $60 million at a $600 million valuation. So it's a really healthy bump in terms of valuation.
Yeah, I was impressed by the effective double in the single year. The disappointment, though, that I got while reading the coverage of it was that they didn't really share a lot of growth metrics. But we do know now that there are 200,000 creators on the platform, which are the kind of people that you pay money to, and, quote, more than 6 million fans. Now, this is the barest of minimal growth metrics that you can provide for a round of this size. So I want to say to everyone at Patreon who decided to not share it, boo, I say to you, sir and ma'am, boo, and boo again. Because this is crap. We can't really do a lot of work here. We can begin to estimate GMV by multiplying 6 million times some, per monthly amount, and you can kind of tinker with that up and down. But I think the trend here that we're seeing is that because the music industry fell apart and so many other kind of creative show up in person things slowed, we're seeing a lot more people effectively try to transition from the physical world into the online world. Bands like Trivium are experimenting a lot with streaming and on-demand concerts, and comedians are doing kind of specials via these new platforms. And I'm pretty encouraged by it. I wonder how much we can replace of the old world with kind of the nuevo Patreon.
I love that Patreon has shifted from being just a marketplace to kind of this suite of tools. I've talked about Issa Rae on this podcast before. I hope you guys have done your research since I last mentioned her. But she uses Patreon in a way that I find super inspiring. And I'm not just fangirling here. I think it's a really cool use case. And we've talked about the creative economy a couple episodes ago, but she kind of has created this ecosystem for creators to maybe all come in because they like Issa Rae, but then network, do offshoots. And it's a really cheap membership, I think $5 a month, just to get access to this this community of Black creators. And so to me, I feel like Patreon having that kind of strategy will probably beat companies that are new to it because it already has a really solid built-in creator network to the small metric point we got. And so that is the future of Patreon in my eyes, creating these small communities where people can just kind of go crazy underneath the similarity of maybe one major creator.
Yeah, and we're seeing this in the 1,000 true fans idea. I've seen it described as the 100 true fans idea. In this case, Issa Rae has just under 2,000 Patreons at $5 a month. So she's doing about 10K a month, about 120,000 a year.
And she doesn't need the money,
grows.
and it's amazing. And I'm like, yeah, you are awesome for not needing the money and just kind of using that as a place for other people.
Yeah, well, I think the idea that we're going to disintermediate the space between artists of varying stripes and creators of varying stripes and people who appreciate them is something that we're seeing across the world. I mean, Substack is an example of this. It strips down the publisher gap between an author and the reader and makes it incredibly personal, more intimate, not in a weird way, but in a very comfortable way. And I think Patreon's the same thing. And, other things like Twitch, and I'll throw OnlyFans in there because everyone talks about it these days, seem to be doing the same thing across different content varietals, you might say. And so if Patreon has caught this kind of lift, I'm not surprised to see the valuation gain. As a final point here, curious to see how its economics are. I think, to me, it's probably seen some great growth, but I'm not exactly over here thinking that it's all of a sudden burst towards profitability. And so I would put Patreon in kind of the traditional unicorn model. Lots of capital, big valuation, good growth, probably losing tons of money. And with that, can we talk about some IPOs, please?
Fine.
And some nods. Okay, cool. Danny and I are both old and partnered off, but Natasha, have you ever used Bumble?
I did when I was single. I used it. It was very empowering because I believe it makes the women ping first.
Mm-hmm.
And so that was cool, I guess, compared to other dating platforms, I guess.
Because women have to initiate conversation versus men, so it kind of puts it gets rid of more creepers, I think was the idea.
Yeah, and I mean, I was always someone who messaged first on all apps anyways, so I didn't need it. It was interesting to see what kind of people I would find on the app.
Cool. I put you through that really kind of awkward gauntlet, and I'm sorry, because I wanted to point out that Bumble had a twist on the market.
Yeah.
And what they've done is taken a different approach to the dating game. And if you had told me a couple of years ago that Bumble was going to go public, I would have kind of laughed at you and said, oh, what went wrong? But in reality, we know how big Tinder is. We know Tinder had I think it was 1.2 billion in revenue in 2019. So the dating market with subscriptions and kind of one-time boost payments and so forth is enormous. And it's fun to see there's more than enough space in the dating market app world to support essentially Tinder as a public company via some other, arcana, and Bumble going public possibly in 2021.
Well, and what's amazing here is, most of these companies are run by IAC. One of the classic rules of venture capital is you never back a dating app because only one buyer in the market will ever buy a dating app. So it's actually incredible to see an actual dating app go public and potentially debut. I mean, it hasn't happened yet. I haven't filed as far as we know, just a leak in 2021. So that'll be a huge breakthrough. And so the folks who kind of double down against the, conventional wisdom of Silicon Valley on dating are, presumably are going to do pretty well in that.
Yeah, I'm excited to see the churn numbers because it's not like regular churn. You don't get over the product and say you don't want it anymore, but you do eventually, hopefully find someone to keep, I think is the idea.
I feel like, remind me, because I don't use Bumble because women aren't going to talk to me for multiple reasons, but I'm curious.
It's the haircut. It's always the haircut.
Yeah. But I'm curious because isn't Bumble the one that's trying to do a little bit more around professional networking on top of dating? Natasha, you're our resident Bumble expert.
I really am not, but I will take one for the team. Bumble, has kind of this business friend functionality. And, I always joke that I would love to have a dating app for friends. I think Tinder had Tinder group before where you could match as a group and meet. Which sounds weird, but I did it in a friendly way a couple of times. And so Bumble, I think that would be a really cool thing I'm excited to see out. If it does file, if it does go through the IPO, it still really could not.
Well, I love the fact that we had 6 IPOs in one day and then there's been no IPOs since for 2 weeks. There's a dry spell.
Well,
it's like a hurricane category 5 followed by drought.
I mean, 8 business days ago, 9 business days ago, 6 companies filed, and we've had news since. I don't think it's that bad. I mean,
I would just ask the bankers to spread them out so that we're more conveniently helped. That's all I'm asking.
Bankers don't tend to give a shit what I think, sadly, and they don't like to tell me things. Okay, quickly then, 2 more IPOs. One, Wish has filed confidentially. Wish is an e-commerce application famous for selling you things that are enticing yet disappointing. I think is how our own Connie Loizos described it in her piece, which I thought was hysterical.
I love that.
I'm paraphrasing a little bit.
Shipping in a nutshell.
Yeah. But the thing about Wish is that even though we giggle at some of its merchandise, it is an enormous business. It's raised $1.6 billion according to Crunchbase, now worth $11.2 billion according to its last round. Tons of active users, 70 million, give or take, across about 100 countries. Big revenue numbers, interesting GMV model. I'm fascinated by this. My question is, how unprofitable is it? And that's my, I'm sure it's growing quickly, but because we all know e-commerce trades at a lower multiple to SaaS, given a different margin structure and kind of business model. And so if it's also super unprofitable, it doesn't quite have that high margin revenue to kind of boost it up. So I'm curious to see how it can do. But I did a little math magic, and eBay trades for about 4x sales. And you can easily see if they do more than 2 billion this year, you can get to around 10 billion. So I can kind of see the valuation working out, but I'm very curious about it. And then Natasha, GoodRx.
GoodRx filed for IPO at the end of August. It's been profitable since 2016. So that's already makes it rare and newsworthy. Founded in 2011, it's a drug discount coupon provider. The reason I think it is going acquired actually has no science behind it or rationale. I just have like a gut feeling that it's going to get acquired because I don't know. I feel like the market for that is doing well right now. Hims is kind of tangentially related. And so I imagine Hims acquiring GoodRx. I just have a feeling.
Well, I guess the last coupon company we talked about was Honey, right? Wasn't Honey bought by PayPal, last year for a couple $billion?
Thank you for explaining in my...
I think we have to give some context for our international readers. So if you're not in the United States and you don't understand what is going on here, in the United States, we have this system where drugs cost thousands of dollars unless you show a piece of plastic, which they cost like, what, $25 on the copay or something like this?
Or
Very
less.
Complicated. I had a friend yesterday who was just tweeting out that he went to one of our local pharmacies, quoted $240 for a pharmacy prescription, went on GoodRx, got a coupon in store, went back to the checkout counter and paid $40 for the exact same thing. It really is like the most incredible, crazy arbitrage, weird coupon business that we've ever seen. And it's mostly a function of just how messed up the American healthcare system is. And so, what's amazing to me, again, profitable for multiple years, it's really a marketing ploy, if you will, right? Most of the pharmacies in the US are built around the notion of using pharmacy to drive store traffic to other more profitable parts of CVS, Duane Reade, Walgreens, beauty, health and beauty, etc. And so they actually don't care. They're not looking to make a huge amount of profit on the pharmacy business. They're just looking for you to come into the store. And the beauty of pharmacy is you have to come into the store repeatedly and regularly to go do so. So I actually think it's a brilliant model. I think the question is, if they are dual tracking, who would be the acquirer?
CVS, Walgreens, the Amazon pharmacy push. I can see. I can see buyers there.
I can see Amazon.
But with a 19% profit margin, they're just an incredibly good business. They make a lot of money. They're growing. I knew about them because I watch old person television, so I've seen their ads. And I just want to point out that if you found Danny's anecdote about prescription drug prices insane, let's say you're in Canada or some other civilized country. Just go look how many medical bankruptcies there are in the United States, and then listen to our politicians say we have the best healthcare system in the world. And the dissonance you see right there is the exact rot that is destroying my country. All right, now moving on. A couple of things we're just going to shout out, and then we're going to let you all go. But if you want to dig more into the SPAC, IPO, direct listing dance, there's been a couple of good pieces out that we've been talking about as a group that we think are worth sharing. So the first one is In Defense of the IPO and How to Improve It by Andreessen Horowitz. Danny, it's long. It's very good. I thought it was delightful. If you were to summarize it for our friends here, how would you gist it down?
I think what the key economic fact that they're trying to remind people is, the price you see on a trade is based off the last trade and the size of that last trade. In a market, let's say for Tesla, let's say there's exactly one share of Tesla available. That share might trade for thousands of dollars because there's maybe some Yahoo on Robinhood who read Wall Street Bets who's like, Tesla 100,000 and is like, I'm going to buy for 10K and that's the only share I can buy in the entire world. The problem is that as soon as more of those shares come to market, you have supply and demand. There's no demand beyond that one person for that one share. At 10,000, demand quickly declines. And so what they're sort of getting at is like, look, we talk about pops and how terrible they are, but what you're really asking is like, is there a market for 15, 20% of companies float, in the IPO process? Who's going to buy it? And what is the universe of buyers who are willing to purchase there? And so it's less exclusive is sort of their mentality. There aren't a lot of long-term hold buyers who are going to pay, a premium for 1% of the shares. Everyone in the IPO has to get the same price. And so even though there might be a couple of retail investors who would buy a couple of shares at a higher price, the reality is that there aren't, people who are going to buy a fifth of the company all in one go. The flip side, the part that I think was a little, you have to read between the lines of where the flaw is like, But part of the challenge is you're just not aggregating the full demand of the marketplace. There are, millions of people who could potentially buy shares on the public markets. You could aggregate those shares up in front. You could even give scores to those folks and ask, how long do most people hold their shares? If people, hold their shares for 5 to 10 years, maybe they can get a slightly lower price or something like that. There's a lot of ways to get more demand, which would raise those IPO prices. So I thought it was a great article. It's about a 20-25 minute read. If you want a whole background on the economic theory of IPOs and how it all sort of fits together with direct listings, it's a good place to go.
And I'll add too, I think we so rarely see disagreement within tech, at least tech Twitter. And so seeing Andreessen Horowitz post this after kind of obviously subtweeting Bill Gurley, I'm sure no bad blood, maybe bad blood. I don't know if there's any. It was refreshing to me as someone who's relatively new in covering tech. There cannot be just the noisiest people that we give attention to. And so I very much loved reading this post and was happy it was written, and think there needs to be more people that aren't afraid to disagree with Bill Gurley.
Yes, but Bill Gurley's Twitter account is very powerful. We don't want to be shouted at by his minions.
I saw this is an aside, but I saw a tweet the other day saying great, you have 100,000 followers or 100K followers on Twitter, join the club, actually say something important. Not about Bill Gurley. But it's I don't know, I think it's we give a lot of undue importance to platforms. That's not a hot take.
I love how the more followers someone gets, the easier their Twitter account gets consistently. When you have 100 followers, you're tweeting about fun things, personal things, whatever. And 10K, you're beginning to get more professional. And then 100K, I feel all you do is tweet out platitudes about business. There's no time in business. There is only, grit, hustle, drive. And everyone's it's amazing.
The future is cheese, not meat.
The future is faux Gouda, apparently, or Fuda, as we call it. And then there's...
I think it was called Nuda, not Fuda.
I was trying to rewrite the historical record.
Fuda is actually also a startup that also supplies, or used to supply, all the food in our offices. So
we need a sarcasm button.
But I will say, going back to Bill Gurley, I mean, Gurley has made it his mission to make direct listings a very common thing. As we talked about last week, the NYSE has gotten, I guess, preliminary approval to allow a capital fundraise with a direct listing. NASDAQ is on its way. So I think what actually is interesting here is just how much innovation is actually taking place. And frankly, the innovation is coming because of the direct listings, right? Because there is this sort of new model coming in that people are now have pioneered with Slack and with Spotify. People are getting better about fees. People are making sure the book is not as oversubscribed. People are making sure the IPO process is more efficient. And so to my mind, this is a great sign that the market is just going to get better over time.
Yeah, better cost of capital for everybody, more innovation, more different paths to the public markets, and as Andreessen Horowitz hoped for, a blending of the public-private divide. We're going to close today with a note that news always happens during the show after we've written the note stock and talked about it. And the news right now, as we sit here Thursday afternoon Eastern time, is that the NASDAQ is off 5% after a long positive run. We are seeing big tech take a whacking. We are seeing SaaS sell off. Things have changed all of a sudden. So by the time you hear this later today, we'll see what the final results are, but it's certainly something that we would have noted if it had happened before the show started, which it did not. And on that note, everybody, thank you. We're back Monday morning. This is Equity. Goodbye.